Alrighty, good. Let's do this. So we're looking at September 2024. Literally, I have been assembling this data over the last 3 hours or so. And so it is definitely a higher than average chance that there are some mistakes in here. And I haven't had as much time as usual to sort of look over things and reflect on them and so on. So we're kind of exploring this stuff together. So if there are mistakes and so on, then please forgive me. But overall, in September, so in August, we started to see values stabilize, which was reassuring because for a couple of months I'd seen activity levels tending towards suggesting that values should be stabilizing, in that we saw lower stock levels and increasing activity at open homes and numbers of offers and so on. And so we did indeed see values stabilize in August, and that trend continued in September, or that phenomenon continued in September. So a bit more of a trend rather than an outlying data point. So that's encouraging. Overall, message to sellers: the balance. The market's a bit more balanced. It's a little better than earlier in the year. By no means is it a seller's market, not at all. But it's not as tough as it was earlier in the year. Message to buyers is we are seeing increasing stock levels again. So the amount of choice you're seeing in the market is increasing again, as you would expect, typically for this time of the year, that being springtime. So let's push into this. Median sale price 792,500 versus 780 a year ago, up ever so slightly. I would call that within the realms of variability of data, so I wouldn't read much into that. Broadly stable since 2022, as I'm saying there, and you can see clearly from that red line there. Basically, it's been going sideways for over 2 years now, a little up, little down, but broadly bumping along the bottom is how I would describe it. If you follow these videos or if you join these calls frequently, you know I don't pay too much attention to the median sale price. A better guide to underlying values, which of course is what we're all interested in, is the Real Estate Institute House Price Index. So here are the league tables. We've had the auspicious privilege here in Wellington of having fallen the furthest than any other region in the country, and it's been that way for quite a long time now, basically since values tumbled right back to roughly this sort of level, as I say, back in July 2022, so about 2 years ago now. So down 24%, just over, versus just over 21% for Auckland, and just under 16% for the nation overall, and 24% is the biggest drop, as you can see there, of all other regions. That is the drop from the peak to where we are now. We did get as low as almost 26% down. We recovered up to about minus 20% down, and we've deteriorated back down to this 24% level. And over the last little while, we've recovered ever so slightly. As you can see there, over the last year, we are down 2.2%. Again, that is the biggest drop over the last 12 months. So Wellington market has been weak again overall in the last 12 months. Pretty similar, as you can see, to Auckland over the last year, but leading the rest of the country. Over the last 3 months, however, it's not quite as well. The weakness that you can see there is easing. So last month, the 3-month drop was bigger than 0.8%. So we're sort of reverting back to zero. And there are other areas in the country, other regions in the country that have also seen weakness over the last 3 months. So that column, at least there, the last 3 months, Wellington is not the weakest market in the country. So phew, that's a bit of a reprieve, but still going backwards. Here we have the graphs here. So that's the shape of things in the Wellington region. So you can see there, the blue line shows the 1-month results. So over here, right at the end of the graph here, you can see the blue line has come up again above zero for the last couple of months, which is what I'm referring to regarding the stable prices again, or ever so slightly positive growth. Whereas for the most of 2024, we had dropping prices. So we pulled back about 4 or 5% throughout 2024 until the last couple of months where we've recovered a little bit of ground there. So yeah, down 2.2% in the last year, 0.8 in the last 3 months. What about the different parts of the Wellington region? And interestingly there, so you can see, look, Lower Hutt and Wellington, the weakest of all parts of all territorial authorities in the Wellington region. Now, remember, the Wellington region consists of 8 territorial authorities, making up that drop of 2.2%. And only 4 territorial authorities are listed there, those being the ones closest to the city. So the ones that are not on this list are Kapiti, Southern Wairarapa, which is like Martinborough and so on, Carterton and Masterton. So 3 for the Wairarapa and the 1 for the Kapiti. Those are the ones that are not included in the list there. But as you can see, the Lower Hutt and Wellington City, particularly weak over the last year. Over the last 3 months, you can see varying degrees of weakness across those 4, 4 different territorial authorities. And interesting to see there, look, over the last 3 months, Wellington region overall has dropped 0.8%. All 4 of these territorial authorities have dropped at least 8%. And so what that tells us is that these territorial authorities closer to the city have been weaker than the other 4 territorial. So Kapiti and the 3 Wairarapas have actually been stronger than these 4 that are listed here. Otherwise, you couldn't get a higher number, or a less negative number, I suppose, would be the other way of saying it, across the region overall. Hopefully that makes sense to you. What about the city? There is the shape of things in the city. So look, we have recovered to broadly a similar-ish, it's the same sort of shape. The last couple of months, we have seen a little bit of recovery. You can see it tends to be more erratic. It's a smaller data size. It tends to be a bit more up and down. And we tend to go to lower lows and higher highs. As you can see there, higher highs, lower lows than we see in the region overall. I suppose that's to be expected when you have a bigger data size. It tends to smooth results over time. But nonetheless, the trend is the same. Generally a weak market in 2024, and that was basically coming off the election. And for those of you who've heard me say this a number of times, I apologise for repeating myself. For the benefit of those who haven't, basically what happened is vendors were on strike. They saw good results coming through in 2023. You can see positive results here in 2023. They were encouraging vendors, but they didn't want to put their properties on the market until after the election. And so the amount of supply going into the election was very, very low. That supported the market. And then we had the election, the government changed, and everyone decided time to put my property on the market now, because things have been going well, and the amount of stock absolutely blew out. And at the same time, buyers had a whole lot of uncertainty around the public sector labour market, and so buyers pulled back at the same time as a ton of stock came to the market, and that made the market a whole lot weaker again this year. And we've just recovered in the last couple of months, really, and that's broadly because I would suggest, number one, we saw stock levels typically drop in winter months, which is normal because everyone thinks winter's a bad time to sell. And we also had the story broadly being interest rates have peaked and they might be coming down, and then indeed very recently they have been coming down, of course. And so that encourages buyers. That's made the market a little bit stronger. Okay, pushing on, new listings. So this is the amount of supply coming to the market. This is not listing volumes. It is new listings hitting the market in the month. The red line there shows us the 6-month average. So we were seeing enormous increases in new listing volumes coming out of the election. As I indicated before, that's the massively steep red line there. And then the last few months, we've seen it going steeply down as we've hit into wintertime. And but in the last month of September, we've seen this big rise up, as you can see there in the blue chart, the blue bar graph. That's quite typical for spring. We tend to get big increases in spring. And as I say, their new listings have risen strongly in September. But when compared to September averages, although it's a big lift on what we saw last September and a decent lift on what we saw in September 2022 and a big lift compared to the previous month of August, it still isn't up to normal September averages. Excuse me while I just let someone in. You know, what does that say? Well, we've seen this big increase in new listings coming on. We were starved of new listings, but that's normal for winter, a bit of an increase. But this big increase is only just up to, broadly speaking, normal levels. So compared to long-term trends, we still haven't seen a lot of stock coming on the market. But a big increase on a year ago and 2 years ago. And there you can see it again. I thought we were coming back down to parity versus sort of a year ago, but no, we've seen a big increase in the month of September at least. What about number of sales taking place? So broadly speaking, the trend that we've seen over the last couple of years has been gently increasing numbers of sales taking place, gently increasing numbers of transactions. We've seen huge increases in supply volumes, but only gentle, moderate increases in transactions taking place. So broadly speaking, that's what's given rise to the buyers market. We've seen sellers keener to list than buyers are to buy. Sellers keener to transact than buyers are to transact. We were seeing volumes of sales nonetheless rising gently, but in the last couple of months, we've seen that, interestingly, easing off. Is that because we've seen new supply volumes coming to the market during winter easing off? I wouldn't have thought so, because although it has been easing off a bit, we've still got relatively high gross levels of listings. So that's an interesting trend over the last couple of months that we've seen number of sales dropping away again. Look at the numbers there, 531 versus 543, 537, broadly the same as 1 and 2 years ago. So kind of no change compared to what's the last couple of Septembers, but no change from low levels. You can see the red line there. We've been well under 600, and typically we're well over 600. We've been around 600 the last few months on average. So look, sales volumes are still not back to what we would consider to be normal levels, not by any means, and they've actually fallen away in the last couple of months. So a few kind of, there's the normal level for August, so still well short of what we typically see in the month of August. So there are a few kind of conflicting messages going on in the market here, although prices, values, seem to have stabilized or recovered ever so slightly. And there it is, the number of sales. So look, it's a mixed bag there. In the last 12 months or so, we were seeing recovering sales volumes, then down a bit, then up strongly, and then most recently that's come back down again there. So you see the red line there. Compared to 12 months ago, we were seeing consistently recovering sales volumes. And the last 6 months, we've generally seen declining sales volumes compared to 12 months ago, although the blue bar chart underneath it will show you that it's been pretty erratic. So interesting times for sure, a bit of a patchy one. How long does it take to sell? In a nutshell, still quite a long time, 51 days versus 34 days a year ago, 56 days 2 years ago. So better than 2 years ago. 2 years ago, it was pretty bad. So 2022 was a dire market. Not as bad as that, not as bad as the really long durations that you can see way up here. But if you look back at what's normal, it's pretty unusual for Wellington to be at 50 days. Long-term average for September, 36 days. So still, 15 days longer than what is normal for the month of September. So by historical norms, it's been taking a long time. Pleased to say at Low & Co, our average is well less than 51, but nonetheless, that's that. And of course, we only operate in the city as opposed to the region, so that might make some difference. Inventory, 15 weeks worth of supply versus 10 weeks a year ago. So just casting my mind back to what was happening a year ago. As I said before, vendors have been on strike. The market was firming. We're seeing some better results taking place based on extremely low sales volumes. What was happening was quite an enormous amount of pent-up supply getting ready to come to market, because for some reason people think that you can't sell before an election, or a lot of people think that as soon as the election was done, boom, a whole lot of property came to the market. So before the election in September, because remember the election was October the 14th, in September we had extremely low levels of supply, and that is reflected there in that 10 weeks worth. We're up to 15 now, so that's a 50% increase. But compared to 2 years ago, again, that was a really tough market, 18 weeks. So better than then, but the market is still tougher than it was 12 months ago on that basis, at least. So the long-term average is 15, and we're at 15. So compared to what's normal over the last really long term, this is what you'd call a balanced market. It doesn't feel balanced because in the last 10 years, 10 weeks is the most average. Over the last 9 years, 10 weeks is what is the norm. So 15 weeks, definitely compared to 10, it feels tough out there. What about TradeMe listings? So again, you can see up and down and up and down. Overall, in the last 12 months or so, throughout 2024, we have seen very, very big supply volumes overall. As I said, after the election, look at that, it's absolutely stark. So the spring rush was really held back because of the election on the 14th of October. The spring rush really didn't start until October, much like we've seen this year. Again, we've seen a late spring rush this year. It was probably even a little later than last year, which really was held back. But after the election, you see those supply volumes absolutely rocketing upwards there. Came back down for winter, and we've seen this big increase again. So, at these sorts of levels, 2,800 or so, you can look back there and say this is about as high as we've been, or almost as high as we've been since way back in the middle of 2015. So, we're seeing more choice for buyers than we've seen, broadly speaking, for about 9 years. So it is definitely good times for buyers. And there it is compared to 12 months ago. So we had seen increasing TradeMe listings overall compared to 12 months prior. Then it started to come back during winter, but it's come back up again, back up to almost 50% more than 12 months ago here in the month of October. So folks, look, there we go. What about the latest frontline kind of activity levels? So this is interesting because we've seen some indicators showing us quite clearly that the market is still soft. Like, for example, the amount of supply on the market shown by TradeMe. We're back up to 15 weeks worth of inventory. We have seen sales volumes coming down a bit. We've seen duration to sell 51 days. This is all hard work, indicating of quite a tough market. On the other hand, for the last 6 months, we've seen increasing traffic consistently at open homes. So this doesn't mean more buyers. It means more engagement on average per listing. And that is quite simply a function, or usually one of the biggest influences, generally speaking, is the number of properties on the market. And this is why we are always saying that, or often saying to potential sellers, that winter isn't a bad time to sell. As you can see here, stock levels coming down, number of open homes coming down as we come out of autumn, say here from June onwards, it's the most marked. And as a result, we see the activity at each open home increasing significantly from 3.5 back here in, what was that, May, up to almost 7 in October so far. So that's literally almost a doubling on average on each open home. So much more activity per open home over the last 4 or so months. This, of course, is good news for sellers. What about offers? Well, that's interesting. We saw an increase in the number of offers. Again, market almost like approaching 2-ish times, not quite. But then this last month, that seems to be an aberration. So we're only halfway through the month. And today's Wednesday, tomorrow is tender day. So so far we've had 2 tender days or 2 tender weeks. So it'll be interesting to see if that number stays low like that, because that at 1.7, that's on average across the whole campaign. The whole listings duration, not just 2.5 weeks for a tender. But I would be surprised if it's actually down that low come the end of the month when all the data's in. But you can see the trend before there clearly is upwards as the number of properties that we're selling in the month comes down. So I just want to dispel that myth that winter is a bad time to sell. It can actually be really quite a good time to sell. So in summary, folks, Wellington values have stabilized in August and September. Listing volumes are down, new listing volumes down overall, but up versus a year and 2 years ago. So down over the last couple of months. Sales volumes have been easing again recently, kind of reversing the trend we've seen for the last 12 months or so. Duration to sell remains long and has been slowly rising recently. Inventory is up, but it's back to long-term normal levels at least. TradeMe listings are up versus 12 months ago considerably, and very recently in terms of September to October, which just shows the spring rush. And so, as I said before, my message to sellers is the market has stabilized. It's better than earlier in 2024. By no means is it a seller's market, though, and buyers, there's still plenty to choose from. It's still a good time for buyers. So if there's anything you guys want to talk about, please sing out. Peter Reed, I've already answered your questions. Oh, well, that's good, Peter. Anyone else wants to say anything, please just sing out. Happy to chat, interested in your comments, or indeed you got questions. Please speak now. Certainly interesting times out there. Obviously, we're seeing interest rates now coming down considerably. That is going to support the market. But at the same time, we're still seeing weakness in the labour market and some economic kind of tough times, it would seem, for households, small businesses in particular, and business in general. Sentiment seems to be still pretty soft, spending and so on. I mean, my personal hope is that interest rates will be coming down to counteract the risks and the challenges out there, and I'm hoping that they will balance each other out. And so prices are not going to race away in any great hurry as a result of interest rates dropping. I think the economy generally needs an opportunity to catch its breath and to work through this pain before it is stimulated again by the low interest rates to enable investment and starting up new businesses and hiring more people again, so the labour market recovers before house prices race away. But hopefully with stable prices and lower interest rates, buyers and sellers will have confidence to transact and just get on with life again. Because I think there's a lot of pent-up demand from buyers. They want to transact, they want to buy houses, but they've been very nervous, and some have endured some pain and inability to raise finance. So the reduced interest rates will enable them to get back in the market again, hopefully, and give them confidence that prices aren't falling and interest rates aren't going up anytime soon. And on the seller side of things, hopefully that will just give them confidence that they can sell again, and let's just stop putting our lives on hold, because there's you can't stop life. The big life events have carried on, but the flow of properties coming to market has really slowed down. So people are holding back from selling, although they want to, waiting for better times. So hopefully they will have confidence to bring their properties onto the market. And that, I think, has really contributed to what's been an enormous amount of supply on the rental market, which has made the rental market really tough. Now, it looks like, did someone want to say something? Was there something from Paul that I see? Ignore that one there. Go away. How's the rental? Oh, yes. Yeah, Paul, the rental market remains really tough. I haven't checked the data in the last couple of weeks, but last time I checked a few weeks ago, we had something like 1,700 properties available to rent versus what's normal for this time of the year until last year. So from about 2017 to 2022, we would typically have about 800 available rentals. And a few weeks ago or a month ago, we had about 1,700. So this is massive oversupply. They'll be driven by all sorts of things. But as a result, yes, rental market's super tough out there. So, rent's pretty soft, vacancy higher than average, taking longer time to rent. But as is typical when the market softens, the good quality properties, the good quality locations are not really suffering. It's the grade B, the grade C properties, grade B, grade C locations, and in particular the student rentals, because that market is really soft because all the students, well, for number one, the student market is really down in terms of number of students. And secondly, the students are staying longer in the halls because they've got so much capacity in them. So those people are not coming out to the rental market. So those, the 5, 6, 7 bedroom places aimed at the students are really, really struggling. I've just written an article actually about a week ago, 10 days ago, explaining why I think that right now is an absolutely perfect time to buy an investment property. I've posted it on my LinkedIn page, and I've done one of my blogs one of my podcasts I've done with Craig Lowe, which I don't think it's out yet. It might be coming out next week, talking about that. But yeah, jump on LinkedIn or find me and connect with me on LinkedIn if you want to read that article of 7 reasons why right now is a brilliant time. And one of them is that the rental market is so soft. So the first order of thinking would suggest, well, that means it's a terrible time to buy an investment property. But if the rental market is this soft, what does the future hold for the rental market? Well, it can only get better, in my opinion. So anyway, go and have a look at that article if that's of interest. Find it on LinkedIn. Anyway, any other questions or comments, or anyone want to discuss anything? No, that might be it. Alrighty, let's see. Thanks for checking in, folks. Hope you enjoyed. See you next time.